Hi, good evening. Today is Friday, May 14th, and it's the exact opposite of how we closed 2 days ago on Wednesday. We had two large down days on Wednesday and closed on the low, and now it's the exact opposite, two very large up days and closed on the high. We had 1.5% up move today on S&P 500, and we are up 150 points from the low made overnight after our conversation on Wednesday. Bonds also had two up days, and volatility was obviously crushed, and it's now back under 20 as well. And Andy, can we look at the levels at the ES
Sure.
futures to see where the volatility trigger is right now? Because we're back at the 41.75 level we have mentioned so many times, and we will see what happens here. But the volatility levels have moved, it looks like, right, Andy?
Right. It's it was at about the 41, about at this level, but with the big down move that shifted down to about 41.10 level. So moving back above that level indicates that we're more likely to see a grind higher from this point. Below that level would signal more volatility, more realized volatility, and above that level, a grind higher. So it's not to say that the reason why we had it's not like causative, but it's just an indication based on where options trades are positioned against this index.
Right. And well, today was a perfect example of what Victor would call a woke day. All the news were very positive. Biden has canceled a whole bunch of executive orders and other directives that Trump has enacted on immigration, monuments, censorship, etc. So, you know, if it's woke, it's bullish, and so we definitely had two very nice bullish days. And the biggest news, at least for me, the most important news, that CDC has finally changed the guidelines on masks. And now if you're vaccinated, you no longer have to wear a mask anywhere, indoor or outdoor. So that's definitely great. And Walmart doesn't even require their workers to wear masks anymore. So science finally has prevailed, even though some states are desperately trying to hold on, like New Jersey, for example, still has the mask mandates, and some other states as well. So apparently listening to science has a very selective idea of when do we listen to science and when do we not. But at least for now in Florida, we don't have to wear masks again, which I'm very happy to hear.
Right. It might start, it might actually help restaurants survive instead of all going bankrupt, right? Which we've seen many of in New York, a lot of boarded up restaurants, that they just couldn't make it.
Right, but science has very selective bias. So if you're on an airplane with the mask, very closed and very confined space, that was okay as long as you don't sit next to each other for a while. But in a restaurant with the same situation, even if you could open windows, it still wasn't okay, even though it's a much bigger space. So, you know, science is peculiar this way.
Right. So, but I think that it seems like people just in general, this is just anecdotal, that people seem itching to get out, and with the weather being as nice as it is here on the East Coast, there's just a sort of cabin fever that people have, and they want to get out. So, well, I do think it's interesting to see that one of the things that's happened over the last few days here with the big inflation report. Now, this is a 30-minute chart, but I think it may even be better to look at a daily chart just to show the magnitude of this. But we had, oh, sorry, this isn't what I wanted. Lumber. We had, it was in this just rip-roaring rally where the previous 3 weeks were almost all lock limit up every day. And with the inflation report, the CPI report, that seemed to top out. And there's some people who were saying, some commentators and analysts were saying, well, this is the popping of that labor shortfall bubble. But I'm not ready to say yes to that yet, but it has been a pretty sharp pullback, but it may just be a repeat of what we saw back here,
Right.
and in January, and then in March. So remains to be seen. This could be the end of the lumber rally, but if construction continues, we have the same kind of shortfall mentality and supply shock type action, and then that could resume. But the pullback in things like copper and oil were much less steep than what we saw in lumber. Crude oil, whoops. No, I'm not sure that chart's going to work right, but silver actually and gold actually up here over the last few days. So a bit higher than where they were a few days ago. So maybe they are responding to some degree to the inflation news.
Right. And also, like you mentioned, gold and silver could be a bit of a hedge for the Middle Eastern disturbances that are going on between Palestine and Israel. So that's kind of
that too.
Right.
And then so sometimes we may see something similar happen with oil, because of the source of at least Europe's oil comes from the Middle East, not necessarily ours, but it's still pulled back today a bit, but it's been it's close to its high for the year.
We spoke about that hacked pipeline, and I think I saw, and it's a bit disturbing, that they actually have paid the hackers the $5 million ransom in Bitcoin, I think.
Right. Well, what they're paying for is the customer billing data, right? That supposedly that was stolen, and they can't bill anybody, and that's why they shut down the pipeline. It's not, they never got operational control of the pipeline. It was all the billing data, and they don't even know who their customers are, evidently.
But
so
how is this possible? Do they not have a backup on a hard drive?
You're right.
Offline? I mean, I worked in IT and in banking, and there are multiple backups.
Sure. Yeah, it seems amazing that there wouldn't be backup for customer data, right? Where you have bank accounts and so on.
Offline. It's usually on a other location offline. That's not, but yeah.
Right.
Interesting.
So it's pretty odd, but we've seen also a big pullback here the past few days, and just a tiny recovery in some of the big cyclical stocks that were, well, maybe not all of them, but some of the big cyclical stocks we've seen a big pullback from the point of that. That I'm not saying that report was what did it, but it's definitely, some have responded positively, like CF fertilizer, nitrogen fertilizer stock, but a lot of tech has continued to move down, and we were talking about the Russell 2000 that did pull back pretty sharply, but it's actually rallied pretty nicely the past few days, and closer to its high now.
Right. And of course, we have to talk about my favorite topic, Elon Musk, how he is now back in action and pumping his favorite Dogecoin again. He tweeted that he's working with Doge developers to improve system transaction efficiency. It's potentially promising. So, and also Coinbase listing of Dogecoin is coming up as well. So Dogecoin got a little uplift momentum in the last couple of days. And also at the same time, Elon Musk was tweeting that they will stop accepting Bitcoin for payments for their vehicles, because apparently it's using fossil fuels for Bitcoin mining and transaction, and especially coal, which is the worst emission of any fuel. So while he's saying cryptocurrency is a good idea, Bitcoin apparently now is not such a good idea because they're using coal. And so I'm just a little confused what he's talking about, because if I were to have Tesla and plug it in in some of those states, my meter is not exactly going to tell me, I just want to use solar or wind. Whatever my power station is using, which could be coal in the US as well, it's going to be powering my Tesla. So how's mining Bitcoin different from powering Teslas? It's the same.
Well, first, most of the mining that does occur in the United States is mostly in the Pacific Northwest, and it's all off of hydropower. So it is renewable technically. We may not be able to build dams now for whatever reason, but it's clean power, right? It's not generating carbon dioxide or anything. And because power in, let's say, Western Washington State, Idaho, and so on is very cheap. It's the cheapest in the US, something like 3 cents a kilowatt. And you can profitably mine Bitcoin, even in competition with Chinese miners and so on up there. So, and there's some that even, they bought forward contracts when it's even cheaper. And so it's actually a big industry up there for some towns. But so that, number one, it just shows a lack of understanding of what's really driving it in the US. In China,
he's also selling Teslas in China, which is the same thing. We're using coal, and China doesn't have any regulations almost for coal. It's the biggest polluter there. So is he going to
what the real issue, what I think he's really trying to do is there's a renewable fuel credit programs. And although they're too big now to be receiving subsidies for like developing electric vehicles, what they want to do and what they're lobbying is to get a new designation of what are called renewable, it's like renewable item number, something like that, and identification number. And what this is a class of renewable fuel credits. And if you make like vehicles or some sort of product that utilizes renewable energy, then you can basically mint these credits and then sell them on a commodities market, on a futures market that's especially built for this. And so if they're able to do this, and Congress and regulatory agencies create this new class of RINs, as they're called, then that'll be the major source of revenue for him. It won't be selling cars. They'll be selling these credits on the market. It'll be the biggest single revenue source for them. And so in order to win this lobbying battle, he has to make the company look like, oh, we care about all these ESG, environmental, social, governance concerns, and we're whatever, sustainable corporation, all of these buzzwords that have to be used to win this kind of PR battle that they want to win. That's really about influencing Congress and regulatory agencies to be very favorable to them. Now, why he would then turn around and claim that he wants to work with Doge developers, I don't even think there are Doge developers. Maybe the people that created it, but if you look at their development activity, like their commits to different GitHub or wherever developers are going to be collaborating, the last activity was like back in 2017 of any significant level. So it's been 4 years since there's been any significant development activity on it. And I'm call me a skeptic. I just think that it's like, how do you on the one hand say that Bitcoin is destroying the earth, whereas Dogecoin, which is also proof of work, is not, or it's easily transformed into something else. But as we were, as Elena and I were discussing, what rallied here really sharply over the last few days, and I'm looking at daily charts right now, are cryptocurrencies like Cardano and Polkadot that these are these are cryptocurrencies that are already proof of stake coins, and they are the transaction currency for their proof of stake platform, and they'll compete essentially more with Ethereum than with Bitcoin, because they'll have smart contracts and so on. It's not quite there yet for either one of these, but you can see that here Polkadot is close to what's now its all-time high. Cardano made a new all-time high today, just within the last hour, and slightly off that high now, which was like right at $2 per ADA. So these are the two biggest, but then there are a set of smaller ones that they may not be rallying quite as well, like Cosmos and so on. They're also proof of stake, but not quite as bullish as Polkadot and ADA, but still pretty bullish. And these all rallied pretty well after that tweet expressing the concern about power consumption, because these are very low in power consumption because they're proof of stake. They require, you could be a validator for these networks just using a regular home computer, whereas for Bitcoin, you need very specialized equipment and a special facility to properly cool it and keep the air circulating and so on. And it's not something that you could really do, that most people could do at home. And you'd have to build something special for it. So it's
can you maybe briefly explain, please, the difference between proof of stake and proof of work, as far as the cryptocurrencies differentiate themselves?
Sure. So proof of work is what Bitcoin is, and it was the original idea behind all cryptocurrency, Bitcoin being the first one, but then everything that followed it for the ones that emerged when let's say altcoins started emerging, they were all proof of work. But very soon after that started happening, there were some that launched that were attempting to solve the problem of, well, this is just going to consume power and we need a better way to do this. And so the idea of proof of stake emerged. And what proof of stake means is that instead of the proof of, so you can think of proof of work as there's miners that are, they're competing to win a block, but there's a consensus that forms among miners as to what constitutes valid transactions or not. And that was sort of the genius of the original code that was developed by Satoshi Nakamoto, was the way that consensus mechanism was achieved, that if 51% of the hash power agrees that these are the valid transactions, then that becomes valid transactions. And if 51% doesn't agree, then you have what's called a hard fork. And that's where some of the coins like Bitcoin Cash or Bitcoin Gold, they were forks of Bitcoin because there were a minority of miners that decided to mine something else according to some other set of rules. So there are proof of work coins that are not forks of Bitcoin, like Ethereum. Like technically, Litecoin, for example, is not a fork of Bitcoin. It was an independent one that just rose up out of nothing, right? But then the proof of stake ones, there were some that emerged, like NEM and I guess Ardor, some of these that have been around for a number of years, that NXM, that they have never really taken off, and they have their certain adherents, but they've never really taken off the way that the proof of work ones have. And that's because, in part, like there's a huge economic incentive to be a Bitcoin miner or be an Ethereum miner. You can make a lot of money from that. And Bitcoin miners, it's big business. There are financial institutions like Goldman Sachs that they have Bitcoin mining operations, and smaller firms too. But so it's a big money maker right now. You get a great return on the capital. That's not like because the proof of stake coins have never taken off, that the rewards to staking are not so great. So it sort of kept them down in the doldrums. But Ethereum is in the process of converting the proof of stake. It will probably happen by Q4 or maybe at latest early Q1 of next year. But Ethereum being at 4,051 and having the second largest valuation of any cryptocurrency, it does provide a lot of economic incentive to stake. And right now, people that are staking in anticipation of that merge, they're getting something like, say 8 or 9% return on their Ethereum, and they're getting it paid in Ethereum. So it's like a very high yield account. You have to lock it up as sort of like assuming that all happens, you'll get a very nice return on your Ethereum by locking it up and staking it. So that's but I think that we're at a point where I don't think that this is going to hurt Bitcoin long term, but I do think there will be a greater attention on these proof of stake platforms. And I think the two biggest ones to watch, other than the Ethereum merge, are Polkadot and Cardano, because they're both top 10 right now, and they have a lot of development activity. Both of the founders, or the people that are the leading developers for Polkadot and Cardano, they both were very early in Ethereum development too. And before that, they were Bitcoin guys. So they've been in the cryptocurrency space for a long time. They have a lot of, let's say, connections and support within the community, within the space. So I think both of them could succeed pretty well and capture a niche. They're not going to take over Bitcoin's place, but they will own a niche. And it's such a fast growing space. All you need to do is own a niche. You don't have to. If you can capture 8% or 10%, then it's an enormous money generator for you and your coin holders. So so that's why I look at something like Dogecoin with a little bit of skepticism. It's like, what is their market share really in the end of people using cryptocurrency? Is it like Polkadot, where there's tens of thousands of developers right now building applications for this, so that people can like have a Polkadot credit card and use it in or debit card and use their assets on that platform just like they would a bank account. And maybe that'll happen for Dogecoin. I'm not saying no, but it's much less likely than a case where you've got some of the sharpest developers in the world working on it. So that's my perspective. It's what does the future look like? Not next week, but 3 years from now. And it's not easy to see that, but I think it's going to be a world where there's Bitcoin, there's Ethereum that will own a big piece of the smart contract space, and then the Polkadots and Cardanos and several others out there that they get their slices.
Right.
So it pays to diversify a little bit, because nobody really knows what exactly is going to happen in the future.
Well, let's look at the Bitcoin chart, because Elon Musk has pissed off a lot of people with his Bitcoin tweets, and lots of his fans are also very big Bitcoin fans. So that's kind of a bit funny that it's now they have to decide, do they still look at him as their idol, or do they go with the Bitcoin? We'll see.
Yeah.
But
Well, I
the
hope
Bitcoin,
that, I hope that people increasingly start to see him as kind of this mercurial figure who he just sort of likes the attention, right? I mean, I guess that's how kind of how I see him, where he, I mean, he's come into this space where there have been people that have invested in this and been developers and really trying to contribute for years. And he comes in and splashing around and tweeting, and
yep.
so what it does is it may excite some of the people that are new to the space that really don't have any sense of the history. I'm kind of in the middle because I came in let's say 2014 or so. I'm not super early, but the people that came in before me really are kind of put off by it, because he's just sort of jumping into this and saying things that he doesn't really understand, that he doesn't understand the big picture, and he's doing it to benefit his company, not investors in general. But I think it's ultimately to benefit his company that why he would make this kind of statement. And because why wouldn't he just come out and say, I'm working with Bitcoin developers to find a solution to this, or to, instead he has to make a statement that's preemptive. So.
Right, and Bitcoin on those news, I think, broke the 50,000 level, and we traded what, as low as 47 something. It's hard to
It
tell.
got down into the 46,000 range, and I'm going to say if we briefly got to, it hit 46,000 at least on Coinbase, and what my observation is, and this is looking at a 30-minute chart, is that that was a big move down, and since it's sort of made these, it's been making a move up. Now, whether or not this is what might constitute a bear flag, if you want to think about patterns to the chart, which people might think is bullish or bearish, then it could. I mean, this sort of has that bear flag look, but in my view, the big important level to look at is about 52,000, and I regard that as a big psychological level, because it constitutes, depending on how you count the Bitcoin supply, it could be, it's the level that constitutes about a $1 trillion market cap. So right now it's just below that. And I think that 52,000 is really important. We also have this, I don't think that line is really anything, but if we look at a daily chart, then we're still, it's still quite a bit above the, things like 50-day, or this is 200-day moving average, is 50 days. So it's still below the 50-day moving average, which is quite a bit higher, 56,000, 56,500. So in this range, it may still be, I think 52,000 is a key level that I'd like to see it get back above. The thing I'd note is that Ethereum Bitcoin ratio has been just going through the roof. It's at the highest level that it's been in over 3 years now. So it did get higher in 2018 briefly, but I've been expecting this to take a pause, but it keeps going up, and I think the news or this Elon Musk tweet, because Ethereum's converting, they're not there yet, but converting to proof of stake, that was relatively bullish for Ethereum. But it didn't pull back as much. The high was like about 4,300, and it's now back above 4,000, in the mid 4,000 range. So I think that I could see this maybe a few more days, but I could see this rally in Ethereum pausing a bit and start to see some a more bullish move in Bitcoin off this secondary low. So we had this big move down from mid-April, and it sort of matched that level, kind of a double bottom, maybe if it moves up here. But if it moves down from here, then it's probably going to bring a lot of the crypto market with it. But we haven't touched the 200-day moving average since last year, well into last year. So back plunged below back in April of last year. So almost a year since it's touched that 200-day moving average, which is pretty amazing rally from that point. But we're a lot closer than we were. It's right now just above 40,000 or below 40,000. And there are people going back to the very early days of Bitcoin that look at this 200-day moving average as a key level. There's a commentator guy that was a very early Bitcoin investor named Trace Meyer, who he's pretty active in social media, and it's just his indicator is Meyer multiple, just a multiple of the 200-day moving average. But we're and traditionally what his analysis says is that above 2.4 or 2.0, the multiple of this 200-day moving average is very bearish for Bitcoin. And we came really close back in this area or here, but we're a lot closer now. We're well below that level. So I don't know. I think at some point we'll tap it. Is my view, but that might be further out here. But I do think we'll have to tap it to confirm the bull market. Tap it and bounce to confirm the bull market.
Right. We also probably should look at the Coinbase.
Oh yeah. Mm-hmm.
And we want to add something like strategy corner to our conversations, and because Andy has lots of very interesting ideas that are not necessarily purely directional, where you could make money in other ways than just by picking the direction up and down on the market. And so one of the things we wanted to talk about is selling puts, for example, on Coinbase, which after the IPO has sold off significantly and was almost as high as 430 level, and we sold
right. It's first day, but then it pulled back to well below 300 and got down to in the about 245 range here about a week ago. And there's not much history there, of course, because it's brand new. But so I'm switch to 30-minute chart. But I think that there's some ways to play this, because when you have a big move down like this, and especially in the last few days where we've had some volatility, and in my view, the Coinbase price seems to be tied just a little too closely to Bitcoin. That if you look at their product offerings, it's all over the place. I mean, they as Yelena said, they're going to be by the end of Q2. So in the next month or so, they'll have dogecoin. So they really want to be this kind of supermarket or all things to all people that are interested in crypto, rather than just Bitcoin, which is what they were pretty much exclusively back in, say, 2012 or 2013. So it's less tied. Actually, their business is less tied to Bitcoin than some people think, but it's trading like it's 100% tied to Bitcoin. So my I did make some trades. I think that that this is a good way to play cryptocurrency, but in the stock market or in the options market. And so I think that the trade was, and it depends on how it looks on Monday. We've got a weekend of market action in crypto that could move either way, but selling at around just a bit on out of the money. So right now it would be about the 250 level to either sell puts or sell put spreads. And it may be too late to sell this next Friday's expiration, but you could look at the next, there are weekly options on this already too. So you could sell the next week out and capture a little bit of the time premium. And so that's one way to play it. Another thing that that I was looking at.
Hold on 1 second. Do you look? You said that, so you usually would do 2 weeks out when you're selling puts in that situation, or do you do sometimes longer, or do you prefer a shorter time span?
Yeah, I think well, you could sell this next. Definitely, it depends on the volatility. And
Right.
what I'm saying, like, is if Bitcoin and crypto moves up a lot over the weekend, then this will not open at 258. It'll open at whatever 265 or something like that, right? And then it may not have the implied volatility may be gone because of that up move. But if it opens around this level, then it could be a great trade to sell next Friday's expiration, because you've just got 4 days, and you're pretty much selling time premium. If you're selling all time premium, but it's going to vanish pretty quickly, and you can capture and get maybe 12, 15 points. It was even higher for a while on for slightly out of the money puts. And so that you can capture some pretty fat premiums by either selling puts or some really wide spreads.
Right.
It could move against you. I mean, I know there's risk inherent in this, but if I think that it's
Right.
at a place where it's more likely to bounce than it is to keep moving down, in my view.
Well, it's also a good strategy if you want to own coin, for example, longer term. Instead of outright buying, you could just keep selling puts when volatility is expensive and collecting the premium. And then if eventually the stock sells off, you could just buy it and have the stock put into you and just buy it out via the put options, meanwhile collecting the premium. But is there a particular volatility level that you look and you see which is high? And I mean, the implied volatility for the options, or is
Yeah.
it also stock specific?
Yeah, so in my view, like 40% or higher implied volatility, that's high implied volatility, and even on something like Coinbase, which, by the way, is a huge company. So these types of moves that we've seen, where it was just, let's say, back here in mid-May, right, mid-April, it was above 422, and now it's at 258. So this is a huge move given the market cap for this, which market capitalization 51 billion company. So it's a good mid cap company.
Right. Plus they have just reported earnings, so the volatility was even higher probably before the earnings report.
Right. That's right. Absolutely. It would tend to be the case. And then another one that has seen a lot of it's really been punished in the market since February. ARK ETF, innovation ETF, and that's you may have heard of, like, ARK Investments. They tend, Kathy Wood tends to invest in these disruptive technologies, including cryptocurrencies, including stocks like Tesla. She was been one of the leading, I'd say, fund managers that were favoring Tesla, even when it was at its low in March 2020. But we actually saw a fairly similar action where, a few days ago it was it sort of hit that low again just in the last day or so. And this was a nice place to sell some premium, like 1 week out, no more than 1 week out, and to sell like the 95s or the 100s. And I think especially as you approach a big monthly expiration and the reason why monthly is a little better than the weekly, you can trade the weekly, but you generally have better liquidity for the monthlies, the big monthly expiration. And then also, like, there's a lot of option games that happen with different hedging strategies that people use, and so you'll see different strikes. Like a lot of times ETFs or stocks will get pegged to their strikes, and so you're taking a little bit of a risk to do it. But if you see a plunge down, then that's time to look at, well, what's implied volatility. And it here was in the 80-90% range. It was very high implied volatility very briefly, so it was good to so I sold a few puts here and did on Coinbase as well.
I think you have mentioned on the last time that ARK was a bit oversold because it was very negative publicity everywhere recently, and so today it had a nice almost 5% up move. So.
Exactly, and I think that's also what, in my view, what makes a good put sale opportunity. But the same could be said, by the way, for selling calls at another sentiment extreme. So back here in February, where this was making new highs every day, and she was sort of the golden child, and her TEDx talks were getting millions of views and so on. Back here, it's sort of the opposite sentiment extreme. So it's just in 2-3 months, it swung to this very negative sentiment extreme, and it's that's not. It's just it's a better time to be a put seller than a call, a put seller than a put buyer, and expecting it to keep going down and profiting from that. So what that is another way to put it. We were talking about these like gamma levels and so on. It's selling a little bit of gamma, but just on, not on the whole market, but on this one ETF, this one security, and it's just for a week. And so unless something really horrible happens in the next week for this, then it should turn out to be a profitable trade.
But you mentioned just for a week. Is that because the volatility was highest at the weekly options as opposed to longer term?
Well,
you said you're selling the ARK, for example, as an example, options with the duration of 1 week, expiring next Friday. But is there a reason why not, let's say, expiring next month?
Oh, certainly. And you get a lot more premium for doing that. It depends on. So what I would say is, one, how long do you want to have exposure to something like this? So I did this in an account where I tend to do short-term trades. So anything from a day to a week, and nothing more than that. But I've got longer-term investment accounts like IRA or something like that, where even though there's some advantages to trading in an IRA, right? But you like something like that, you want it to be around for your retirement, so maybe you're thinking about longer-term trades. But I've sold puts in even retirement accounts but it's longer term because I want to acquire that stock, just as you were mentioning, at a certain level and collect premium until I buy. And you can end up getting a very good cost basis. I mean, like shave 20 or 30 points off of an entry by being a put seller, and with the intention of eventually being an owner, and that you're not averse to owning it at that level. But that's, you have to think about your strategy with either that account or overall. But something like if you're selling puts, the risk is, of course, you get put the stock. But what some people do, and this is something that to keep in mind, is that most brokers will let you sell puts, naked puts that are not where you're covering it with margin. You're not fully covering it with cash. And of course, if you're in a market where it's bearish and you're trying to sell puts and you think you're being clever, you can get killed. And that's exactly what exacerbated the 1987 crash, was what people call portfolio insurance, which was really selling puts and to do, enter stocks and things like that. And it didn't, as the market cascaded down, these put sellers were forced to buy back their puts so that they didn't go insolvent because it was all margined up. And so I would just say my advice is look at your leverage and so on, because you don't want it to be your own 1987 crash in your account because you were levered up. But as long as you're using it very lightly and judiciously, and this isn't, or the other thing is if you have if there are other things that you think are could be going down at the same time where it's or going up. I mean, for example, one of the things we'll talk about on Monday is some biotech stocks. And this has been one, Regeneron, where it's partly a COVID play, but they have a lot of other products. But they have had some products for COVID that were used in treatment of COVID. But this has been a great one to on these pullbacks to buy long calls and to trade the calls. If you really wanted to buy something longer term, you could have bought like leaps back here. Right now is probably not the best time because the calls have acquired a lot of premium, but here they could have been bought a lot cheaper. But
was the volatility though high for the leaps there?
So that's the thing, that it's like that's the volatility is, the implied volatility is working against you at that level, but the price generally what you see, and it's just my experience, that sometimes during the sell-offs, and it's not it's sort of an inefficiency in the market that you can see that the implied volatility of puts will actually be different than calls, that especially after a long sell-off like this, there's some inefficiencies in the market, and it would be very hard to you'd have to have a really, really big position to arbitrage that away, like to be the arbitrager or take advantage of that inefficiency. But on a smaller scale, it can pay to be a longer term call buyer here, even though the implied volatility is a lot higher.
Right.
So you could buy. So what you could do is sell puts and buy calls with the premium, and then you have even more exposure to it. And so that's one way to do it.
Sounds good. Thank you, Andy. Very interesting about involving options into the less directional place.
Mm-hmm.
With
that trade that I just referred to, if you look it up, it's referred to as a combo often, where you're selling puts and buying calls. And again, you have to be very careful. How much are you levering up? Because it's like a very aggressively leveraged position, but as the thing I'd point out is like having a big buffer of cash, but then taking some highly leveraged positions that are directional depending on the situation. It's the way that you can get very high returns. And as Victor says in his books, you can't expect to get, very large returns without also taking sizable risks. So, but I think it's, I'm not saying that people should just, gamble on this, but it's seeing how using things like implied volatility and some of these other sentiment indicators or quantitative tools where you're looking at, let's say, the number of days down versus number of days up, or other markets that are correlated to this as an indicator of when to enter. And so somewhere back here in March, end of February, early March for Regeneron was a really good entry. And I don't know, I think that it should continue to perform well, regardless of the situation for COVID. But it is indirectly, or it's partly a COVID play.
Right.
But we'll talk more about this one and some others on Monday too.
Yep. Sounds good. Thank you, Andy, and have a great weekend.
Thank you. Good weekend, everyone.